Good afternoon, ladies and gentlemen. My name is August, this is Caitlin, and this is Ashlyn, and we are Panda Capital Group. Before we get started today, we'd like to discuss Stable Capital Partners' investing philosophy. So first up, Stable Capital Partners only invest in 1, stable properties, and 2, properties that generate at least an 11 to 13% IRR. Today, we are going to be discussing our 200,000 square foot office property with a current lease of 3 years. This property is located in a top 5 market for life sciences, and while this may be attractive to some investors, we've decided to refinance the property as an office asset and hold for 4 more years. In terms of looking at the property, there are 3 primary value drivers. The first being that the current rents are 33% below market rents. And so our current tenant, we really don't think they will default, and so the risk of credit loss is very low. Second off is the opportunity to refinance and give us 24% more leverage, drop our interest rates by 105 basis points, and then extend our amortization period by 5 years. And then finally, this gives us the opportunity to, if we wanted to, eventually convert the office property to a life science building in the future. And then as you can see, we have a $170 million total budget. This generates a 20 to 21% IRR, a 2.1 equity multiple, and this is all over a 4-year hold period. Next up, we're going to hit on the market and the impacts that the COVID-19 pandemic has had on the 4 major asset classes. So starting off, we have office properties. Office properties have seen a drop in demand just because more people are working from home. Cap rates have risen and property values have dropped. And currently, Stable Capital Partners is underweight in this asset class. Next, we have retail properties. Retail properties, the cap rates have risen, and these properties are going to need to adapt to buying habits of delivery and curbside pickup. And so currently the fund's position is also underweight in this asset. Next, we have our bright and shining star, multifamily. Multifamily has been one of the most stable assets in terms of the pandemic, and the low cap rates for this property have attracted more venture capital or more capital from investors. And currently the fund is overweight in this asset class. And then lastly, we have industrial properties. As everyone knows, industrial properties have seen all-time low cap rates. The rise of e-commerce has made this a significantly high demand property. And so we did miss the boat in industrial property, but we still hit on the 3 other main asset classes, and that's a huge success for us. Here is a chart from RCA showing the downtown office properties have dropped in value. Industrial properties have skyrocketed since the pandemic. Suburban office and retail dipped originally, but are on the rebound. Another symptom of the COVID-19 pandemic has been rising inflation rates. Right now, we're seeing a CPI of 5.2%, which is something we haven't seen in over 30 years since the 90s. And so now we're going to talk about what that means for different asset classes. So first off, we have self-storage properties. Self-storage properties are a very good investment to have during periods of high inflation, just because you're able to get up to market rents relatively quick in the short term. Next, we have multifamily properties. Multifamily properties usually have leases of 6 to 12 months, which is also good in the short term, just because you're able to market or get back up to market rents fast. Next, we have industrial properties. Short-term leases ranging from 3 to 5 years are more favorable than long-term leases of 7 to 10 years. Still not as favorable, though, as self-storage or multifamily because they will lag behind with high inflation. And then finally, we have our long-term office properties. And so these are probably the least desirable in terms of periods with high inflation, but there is a way to mitigate this risk, and that is to tie our rent escalations to the CPI to kind of be to be more risk averse in periods of high inflation. And so now I'm going to pass it off to our strategic advisor, Caitlin, who's going to discuss our 3 strategies going forward.
Thank you, August. So as we were analyzing this property, we took a look at the 3 opportunities that the firm presented us with, keeping in mind the firm's focus on investing in properties that are stable and income producing. So our first option would be to sell the property today. Our second option would be to hold the property with the existing lease or existing loan in place. And the third option would be to convert the property from an office building into a life sciences building. So taking a look at our first option here, which would be to sell the property today, if we were to do that, we would generate an IRR of 9 to 10%, which is slightly below the firm's target of 11 to 13%. But if we were to sell the property today, we can reinvest that money into other ventures, such as multifamily or industrial, as that is the firm's typical focus. But because we are currently overweight in multifamily projects and underweight in industrial, we would recommend taking the money from the sale and investing it into an industrial property to diversify our portfolio. And then taking a look at our second option here, which would be to hold the property as its current use as an office building with the existing loan in place. Our current tenant is an investment-grade technology company with 3 years left remaining on their lease. So if we were to hold the property with the existing loan in place, we would hope to ride out the 3 remaining years with our current tenant and release the space, generating market rent, as our current tenant is paying 33% below market rent. So when we roll over the lease, we can jack it back up to market prices and generate a 33% increase in NOI. And then taking a look at our third option here, which would be to convert the property from an office building into a life sciences building. So currently our property is in a top 5 market for life sciences, and locally there's a 99.5% occupancy rate for life sciences buildings. So this makes this seem like a very attractive offer, but when you consider the 2-year construction period in addition to a 1 to 2 year stabilization period, it's important to consider these things before proceeding with this option. So now that I've gone through our 3 options, I'm going to pass it over to Ashlyn, who will dive deeper into our decision analysis.
Thank you, Caitlin. All right, to determine the best strategy for the fund, we looked at 2 of the strategies at a time, starting with sell versus hold. So selling right away would secure a 9 to 10% IRR, which is below the fund's target IRR, but it would return that capital right back to the investors pretty immediately, opening up opportunities to invest in other asset classes such as industrial. However, when we built out an income statement for the remaining 3 years of the current tenant's lease, followed by a release or the entrance of a new tenant at market rate, we realized a return between 14 and 15%. And again, we're able to do that by increasing those rents up to market rate, which then increases our NOI by 33%. So out of these 2 options, we determined that holding is the most prudent option. Next, we compared hold to converting to life science. That life science conversion would return 15 to 16%, which is a little bit higher than holding. However, it does come with increased risk. And that risk comes in the form of construction with higher material rates and labor shortages. It comes in the form of stabilization, moving from 1 tenant to then needing to find 10 tenants to fill the life science space. And it also comes in the form of a bit of an alignment of interest issue with the operator looking to put in 2.5% of the equity, but then demanding 25% of the profit. Additionally, there's 3 million square feet of life science under construction in the market, and that's 3 million square feet of life science specifically made for that purpose. This building was originally built to be an office building, so it could potentially fall short in some of those specific requirements that tenants are looking for. So out of these 2 options, again, we decided to hold. And then we dug a little bit deeper and found an additional opportunity to create value for the fund. And we did this by looking at the current loan in comparison to market terms and realized that it is significantly inferior to what we can get in the market today. So by refinancing, we'd be able to increase our leverage from that 42% up to 65%, a 23% increase in our leverage. We'd be able to decrease our interest rate from 4.8% to 3.75%, 105 basis point decrease. And finally, we'd be able to expand that amortization period from 25 years to 30 years. All of that combined leads to an IRR of 20 to 21%, which is a whopping 500 basis points higher than the risky life science opportunity. So we determined that refinancing is the best, most stable, and most profitable option for the fund. And then to summarize kind of everything I said in the last 3 slides, here's the unlevered, levered, and structured returns. Where I really want to bring your attention is down to the structured returns. Looking again at that life science conversion with an average IRR of about 15.2% compared to holding as an office with the existing loan, getting that 14.5%. And that 70 basis point difference is just not substantial enough to cover the risk of construction and the other risk with the expensive operator. So that would not work anyway. And then those in comparison to the office hold with the refi loan, it just knocks it out of the park with that 20.7% return. And we can do so without really much additional work at all. All right, and now I'm going to pass it back to August, who's going to dive a little bit deeper into the financials.
Thank you, Ashlyn. First up on our financial analysis, we're going to look at the SWOT for refinancing. So like every property, there's going to be weaknesses, there's going to be threats, but ours, the strengths and the opportunities significantly outweigh those threats and weaknesses. So first off, our first weakness that we focused on was that it is a single tenant building right now. And so in terms of the pandemic, it could be risky to some other firms that might default, but we're really not worried about that. We have an investment grade technology firm that's currently in there, and they have weathered the storm of the pandemic. They've triumphed through it, and they're paying below market rent, so we're really not worried about them defaulting. Second up, we have poor market conditions, obviously with a drop in demand due to working from home. We're going to mitigate that, though, by developing relationships with potential tenants and offering a significantly high TI or TIs for the property. Next up, we have threats for the property. That includes rising inflation, like we talked about earlier. And so when the leases roll over in year 3, we are going to tie the rent escalations to the CPI index just to kind of alleviate the burden and lower the lag behind. And then also, like we said earlier, the threats from working from home. Like we have a current technology company as our tenant, and technology companies thrive off collaboration, and so we really aren't worried about the increase in working from home taking away our profits. And so now we're going to tackle the strengths. So you can see, or like we've talked about earlier, we have the existing tenant. They're on for 3 more years. We're not worried about them defaulting. We are getting above target returns by up to 1,000 basis points and around 800 to 1,000. And then lastly, we are still able to diversify our portfolio by having an office property, which we currently are underweight in. And then finally, looking at the opportunities, we are able to refinance the property. And then when the lease rolls over, we will be able to generate market rents. And then finally, we won't be converting the property. It's too risky for us, not high enough returns, but someone could in the future. Now we're going to take a look at the sources and uses. So $5 million is allocated for the loan origination costs and TIs, and then the other $165 million comes from the purchase price. And then for sources of capital, we did refinance and increased our leverage by 23%. So that's where we're getting the 65% that's coming from debt and 35% coming from equity of the total $170 million. Next, we're going to talk about the cash flows for a $100,000 investment, or for a hypothetical $100,000 investment. And you can notice that these are relatively low, less than 1.5%. And so the reason why that is because we put 80% of our operating revenues into a TI escrow account to make up for if we do lose our tenant and need to pay TI improvements after the lease rolls over. And then also we generate a 2.1 equity multiple at reversion, which makes this deal a home run. Finally, we have our IRR sensitivity analysis for refinancing. As you can see, worst case scenario for market rents, if we get low market rents, and if we get a high exit cap rate, and then also if we do drop our TIs by $15, we're going to see that our option or refinancing is still the best option to have. Even with a drop in all three of them, we're still going to hit that 11% return that we really focus on. And so with that, I'm going to pass it off to Caitlin to conclude our presentation.
Thank you, August. So to conclude our presentation today, I'm just going to be going over some of the risk mitigation and some of the risk associated with refinancing the property and holding it as is. So we have three main concerns. The first one has to do with the current lease. The second one has to do with the rollover, and the third has to do with reversion. So taking a look at our current lease, our current tenant is paying below market rents. But at the end of the 3-year lease, we plan on bumping those rents back up to market rent in order to mitigate that. A second concern that we have is rising inflation rates. So inflation is rising rapidly currently, but at the end of the 3-year lease, we plan on shifting the rent escalations from 2.5% annually to being CPI adjusted so that we can account for that rising inflation rate. Second, our concern with the rollover. If our tenant chooses to not renew their current lease, we have already budgeted for TIs as if we were taking in a new tenant at the end of that 3-year lease. So we are completely prepared for that situation. A second concern with rollover is the unknowns associated with COVID. So many employees are choosing not to return to the office, and a lot of are choosing to continue to work from home. However, we believe that our investment grade tech company values in-person collaboration and thrives off of going to the office. So we feel confident that a tech company would want to work in the office in person. And third is the risk with reversion. As cap rates are rising, we did our sensitivity analysis to see how much an increase in cap rate or a shift would affect our overall return. And we found that even an 160 base point shift in cap rate, if that were to occur, we would still be able to achieve the minimum target of an 11% IRR. So with all of those risks considered and mitigated, we would just like to affirm our decision to hold the property with a refinance loan because we believe that is the most prudent option for the firm that aligns best with their investment values. Thank you. We will now open the floor for questions.
Either the existing tenant renews or we bring in a new tenant. In our model, we built out 8 months of vacancy for that to release.
Is it one tenant or is it multiple?
It's one tenant for the space currently.
And then
We did it based off of a current typical, like in the market value of $60 per square foot, and then we trended that until year 3. It ended up being around $64 a square foot, and then the total was just under 13 million. So.
And we did budget it so that it would be the same for renewal as the same as finding a new tenant. So that what we're going to give to the renewing tenant, if it happens, we would still give them the 60 with adjusted.
Oh, great.
So you had a slide which kind of broke out your equity injection and then your distributions coming out of it, and had like a red cell which said, yeah, this.
Yeah.
What's the $100 million investment? What's that tied to?
The 100.
How do you get to that 100 million?
That's just a hypothetical $100,000 investment.
Oh, okay. So
Yeah, so it's just hypothetical. Yep.
We believe that there is not much of a risk with the releasing of the tenant. As it stands right now, they are getting the space at a level that is below market, and even if we couldn't reach all the way up to those market prices and we did some negotiation to get them to stay, we would still achieve a return that's higher than
Also,
Life
it is a 4-year holding period, and the current tenant is for 3 years. So it's a little less risky than if the lease was up in a year or so.
Didn't you mention an escrow that a lender was doing?
Yeah, not the lender, what we were doing.
I think the numbers kind of speak for themselves at this point. I mean, we have a tenant that is, stuck with the property for an additional 3 years, and I mean, call me an optimist, but I think that the market could be a little bit better by then. And again, tech is just a booming industry. They like to be around each other. They like to be in office, so I think it's a good one to hold on to. And again, we remain being able to convert to life science eventually. You know, that option doesn't go away either. So.
Thank you.